So most investors invest in a way where they look at property just as property, but property is like a stock market. There's over 15,000 suburbs in Australia, and when you look at property, there is multiple opportunities. So if you treat it like a stock market, there's companies at the same time doing well, and at the same time there's companies not doing so well, and that's investing. Property does the same thing. If Melbourne or Sydney are doing well, doesn't mean the whole country is doing well, and vice versa. If there's other parts of the country doing well, Melbourne, Sydney's not going to do well. So today, by the end of this episode, I want to explain how property works, talk about regional versus capital, talk about diversity, but also just talk about history of the property market and what it's done in the past, because I think people have this conception of, I want to be next to a capital city because that's capital growth. If anything, capital cities are probably more receptive to downward swings than regional towns.
Okay.
And so I want to talk about this. This is not to convince you to go into regional, but it's to convince you that there is markets in markets and that there's so many opportunities. You've got over 15,000 opportunities in Australia. So people only think of Melbourne, Sydney, and that's it. They don't look at the opportunities around the country. And when we're looking at opportunities, I'd like to be in towns that are probably over 10 or 20,000 people.
Yep.
Okay,
At a minimum.
So at a minimum. And people sometimes think, there's no stability in those markets. If anything, there's probably more stability. So we'll talk about that and reveal that, and we'll talk about some downswings that have happened over the past.
I'm excited. It's. I like the fact that you said 15,000 opportunities, and which opportunity you're going to choose out of the 15,000. So let's do it. Let's rock and roll. Let's swing it. I'll be the devil's advocate the entire time and test you.
Yeah, and I think what we're going to start on with, I think we look at Melbourne, Sydney, two powerhouses. Sydney's got the biggest population, then Melbourne comes second.
Yep.
They do believe in the next 10 years that Melbourne will exceed Sydney's population.
Yep.
It's growing quite fast. Majority of the overseas migrants go into Melbourne. But regardless of the population doesn't mean anything. And I think we talk about a lot about internal migration, population growth. It's important, but it's just one thing when it comes to property markets. The crazy thing is Melbourne hasn't always been one of the most expensive towns.
Okay.
Same goes with Sydney.
Yep.
So in 1970, Perth was actually more expensive than Melbourne, and Sydney was more expensive than Melbourne.
Gotcha. Yep.
And then as life goes on, things change. We get to 1980, Canberra is more expensive than Melbourne. Sydney is more expensive than Melbourne. Melbourne was fourth on the list of the fourth most expensive city. Mm-hmm. Very similar to what's going on today. I know Canberra's not up there, but there is correlations when I'm reading out some of these things. There is correlations with what's happening now. If Melbourne's, I think, number 4, most expensive city. Adelaide and Brisbane has passed that, and I think even Perth is on the verge of passing Melbourne soon. So we look at that. Now, there was a correlation of things starting to happen here in 1986 when I looked at Sydney, Darwin, Canberra, more expensive than Melbourne. And the funny thing was 2.9 million people in Sydney, around 2.6 in Melbourne, 70,000 roughly in Darwin, and about 250,000 in Canberra.
Cool.
So if you look at Darwin, Canberra's population, Canberra is nearly like a Townsville, what it is today. Darwin's quite similar to, like a Rockhampton, you could say, or maybe a little bit smaller than Rockhampton of the population. So the population is quite small in Darwin, but if you look at 1986, it was more expensive than Melbourne. So there's swings. And what I'm trying to explain is that there is things that happen to a property market. And I know we're talking about capital cities here, but of course there's also the same thing happens with regional towns, and we'll get on that in a sec.
And it's not all just reliant on how big the population is, which is going to drive the economy outside of what most people might think.
Yes, correct.
And okay, cool.
Yeah.
Okay, awesome. I'm going to play devil's advocate with this because I know from my team, everyone goes, well, Melbourne has to be the place to invest now because population growth and whatnot. So it's going to be interesting to see what your thoughts are on that specifically. But let's keep it rolling.
Yeah, so I think there's certain indicators are lining up, not for every place. There's a lot of places that still have the GRP has gone backwards or it's been decreasing over the years.
So just pause. What's that mean?
It means that the economy is not expanding, it's contracting.
You're talking about local government areas?
Yeah, local government areas.
Okay.
So when that starts to happen, you're looking at a market that is not starting to produce goods and services, or it's reduced its turnover from the years before.
Cool.
And so it's not making as much money. And that plays a big part of property markets. People like to look at property data. Property data is great, but it's lagging, and not just that, it's just showing you what's going on like now or what's happened just in the past.
Yep.
And so you're not going to look at data that is showing where the economy is going with that. And so what happens is a lot of people come to us, get it all the time, go, we want to invest in this area. We're looking at property data. Market's looking good in this area. Fantastic. You're too late. You're too late. I don't look at property data. I look at the fundamentals first. I look at what the economy is doing, because I'm trying to forecast before I start to see days on market going down, sales listings are really low, vacancy rates are extremely low, and all those things are moving in that direction. If I look at that first, then we're too late to a party.
Yeah. Okay, so you go the other way first, fundamentals. Cool. Okay, let's roll into what you were touching on. I just had to break it in there, but yeah, let's roll in.
So keep moving. We get to 1986, 1993. In between there, we had a recession. Mm-hmm. We had a recession in Australia. Really hit Melbourne. Melbourne was affected. At that point in time, Sydney was number one property market of expense. And then, of course, it was Canberra. And then after that was Darwin. So we still had this trend that Melbourne was still not the most expensive property market and wasn't the best place to invest. Okay. Then 2002 comes into the equation here. 2002 was the start of an era where around the country, we started to see places have significant growth, and they called it a nationwide boom. Very similar to what happened with COVID. When COVID happened, you had a majority of regions that were on fire.
Yep.
2002 to 2008, that same thing happened.
Yep.
Not every area was treated the same. There were places that had nearly 200% growth during that time, which we'll touch on in a second. We'll go through that. But things happen. And what I'm trying to say is, regardless of the median house price doesn't mean the growth, regardless of the population doesn't mean the growth, regardless of how big the GRP is in that area, regardless if it's Melbourne or Sydney, there are other places that can outperform Melbourne and Sydney.
Cool.
And it has happened with the past.
I'm keen to understand what these regions are. I am keen to understand what these regions are, because I only want to invest in capital city.
You want to only invest in capital
city? Yes,
city?
I'm going to be the viewer today, and that's how I'm going to face this. You need to try and convince me otherwise.
Well, what I want to talk about is, let's talk about some booms and busts. Okay, before we get really into all this stuff. And I think booms and busts are important. I want to talk about the Perth market. Mm-hmm. So Perth had a boom. 2002 to 2008, Perth achieved around 150% growth. So as an investor, you want to be getting into that market. At the same time, I think Sydney had 26% and Melbourne 60% growth in between that time, from 2002 to 2008.
Very similar to what's just happened over the last 6 years.
Correct.
Yep.
Correct. So with that, that's, of course, you don't want to be investing in a market like that. But with Perth had the strongest population growth and internal migration pattern.
Okay.
So with that, there's a correlation that, during 2002 to 2008, we started to see population growing. During that time, GRP growth was growing. One of the strongest GRP growths during that time, as well as job growth, was on fire.
Cool. And people moving in there as well.
Correct.
Yeah.
Yep. So job growth was around 2.3% annually. So you look at that, it's very strong for job growth.
So again, can we just break that down a little bit further? What's that mean? 2.3%?
New jobs getting created into Perth.
Okay.
And so with that, more people are getting attracted to coming there. Yep. And we started to see internal migration, population growth in general start to grow.
Cool.
Okay, we had the mix of both. And with that, you started to see the property market do well during that time. That's why I grew 150%.
Okay, so you're not... If it was just population growth and not necessarily internal migration, so kind of because you just mentioned before, no, population growth is not as important as...
What's the type of population growth? Because population growth, you've got newborns.
Yep.
You've got overseas migration, and then you've got internal migration.
Gotcha.
So you got to look at the data specifically.
A bit more granularly, yeah.
I'm going to do a video on this. It's quite interesting. I'm looking at Geelong, and Geelong's got this massive internal migration pattern. Great. Where is it going? It's going to all these new estates. The new estates in Geelong area aren't doing very well.
Okay.
And so you look at like Armstrong Creek and Mount Dundee, all these areas, this is where the majority of these people are migrating to. The property market's doing nothing there. And there's a lot of buyers agents in these areas in Geelong saying Geelong's the hot spot. Or when you look at the fundamentals, it's not majority of those internal migration patterns is not going there. So you've got to look at the data very specifically.
Okay.
Migration growth is important. Yes. What type of migration growth?
Okay. So where are they actually going? What are they
And what
producing
type
to the GRP? What are they producing and why are they moving there?
And what type of that population growth? Is it internal, overseas? Is it natural births?
So this had both. So you said internal migration, people moving there for job opportunities.
Yeah, they're the ones that are going to affect the property market the most.
Yep. Cool.
So
go on.
With that as well, we had output. So the outputs of the economy, how much is the output of, Greater Perth doing and, what's it doing for the economy? 8.5% per annum of output from the industries, which is one of the strongest outputs during that time.
Okay.
And with that was contributing a lot of billions and billions and billions of dollars. Of course, the mining sector was there. That's the one that's the biggest producer. And over that 5-year period, it was over $20 billion of output. So there was a lot of money, during that period. Okay, that was happening. So with this, I look at, during that Perth era, Perth was on fire. Melbourne, Sydney went back, really didn't grow in value, 20 to 60%. Mm-hmm. We had Bustleton, 202%, Geraldton, 200% roughly. Mm-hmm. And Albany, there was another area that was growing around that 150% plus.
Yep.
So the whole of WA was on fire. The whole economy was on fire.
Yep.
And internal migration, very similar. Okay. So I look at that. That's a very important sign. Then we fast forward. Okay. We go from 2002, we go to 2002, and then we go to 2012 onwards with Perth. From 2012 onwards, we had the mining boom that started to really fall off.
Yep.
And the property market really started to retract.
Yep.
And so during that time, people were heavily investing in Perth and parts of WA. From 2012, we started to see a massive downward swing.
Okay.
Do you want to know why?
I do. And I'm putting myself in the viewer's mind of saying, yeah, that's all great, getting 200% growth, but that's useless to me because then it was worth the same in 2012. So yes, I'd love to understand why.
So we had GRP growth that started to reduce and decrease. We had local jobs started to drop. It dropped by 12%.
Okay.
Which is not a good sign. And then since 2013 to 2024, we had, this is a little bit off topic, but we had, of course, the mining sector started to drop during that time. And over that time as well, during the 2013 to 2018, the mining sector dropped. Of course, other sectors started to drop because the GRP started to reduce. But then during that 2018, 19 plus, they started to invest in other different industries, and now Perth has kind of changed, but we'll kind of touch on that in a sec. And then the output as well dropped by $17.5 billion over that period from 2013 to 2018.
So tell me what then, because the data's fine, what actually occurred there? What actually occurred? Was there like a mass exodus? What was actually happening that caused an entire city, an entire state to shit itself? Which we don't see very often. You
start to see, of course, that it's very reliant on the iron ore and the mining sector. That started to really drop off, and people started to lose jobs.
Yep.
That required people going back to home.
Yep.
And a lot of them don't actually probably live in WA. There was a few things with BHP and a few other big mining companies where they were doing the fly in, fly out sort of stuff, and then they started to stop that, and reduce that. And so, there was also, that started to happen, FIFO, where before as well, what they used to do was they didn't do that and they would pay for accommodation in these areas. And some of the housing sector, like, you had Port Hedland, it went from $200,000 medium house price in like a couple of years, it went to $1 million.
Yeah.
And then it dropped back down to $200,000. The reason why is because they brought in FIFO, fly in, fly out. Okay.
Gotcha.
So that happened with mining sectors, but of course the whole of WA started to go into a bit of a recession. And because it's really reliant on one sector, that's not a good thing. And it, of course, over time now it's changed. So since 2018 plus, it started to invest in other industries. Now look at Perth as not really too heavy resource. It's starting to diversify.
Cool.
Which is great. But as you can see, output, GRP, population growth also decreased during that time. So you started to see the property market start to retract. It was the worst performing property market from 2012 to 2018, done nothing, went backwards in value.
Which again, people hear that, they go, oh, that's really risky. Melbourne's done the exact same thing for the last 5 years.
Yeah. Of course, Melbourne's probably not as bad as what Perth went through.
Not backwards.
It went backwards still, Melbourne, but not as bad as what Perth did. And the population, the internal population went from 2013 to 14, we had a plus 1,500 people. Then we had in 2014 to 15, had a plus 250.
Wait, where's this?
This is in Perth.
Gotcha.
Greater Perth. And then 2015-16, negative 3,500. The following year in 2016, negative 7,000 people. Then the year after that, in 2017-18, negative nearly 6,000 people. Then the following year after that, 2018 to 2019, negative 1,400 people. So there was a decrease of internal migration. People are leaving.
Got you.
And that
mass
starts
exodus.
It starts to have a massive effect on the property market.
Of course. Yep. Okay. And all things that you can pick. Again, same. I'm just referring it to your Melbournes and your Sydneys now, kind of from 2018, 19, kind of COVID, kind of kept that property market going for a little bit longer, but there was that exodus as well, right?
Correct.
Cool.
Yeah.
Okay.
And so we're all probably you see this in most towns, and it's sometimes not as aggressive. You'll see this a lot aggressive where property prices will decrease a lot in small regional towns.
Yeah.
Like they'll have that massive downward swing.
Yep.
But as well, sometimes you see this, of course, in areas that are very reliant on one sector. And that's why I think the government in Perth or in WA in general have tried to make it diverse as well.
It's its own little country now. Okay, cool. That's not convincing me at all to go, okay, well, just like that, if anything, that scares me to go into let's call it a Perth. I know obviously we've purchased quite a lot of properties in there because there's a huge, huge shift, and our clients and even ourselves, we've had some awesome success. But I want to break down this regional versus capital thing, because my biggest thing here, or if I'm just being the viewer, it's still a concern of like, well, hang on, I'm just better off being in a capital city. I'm like, there's more risk being in a regional town. There's more risk being in a, call it a Perth that's only reliant on one or two sectors. So let's talk about that.
So,
Shabba.
so when we look at, say, Sydney, and we go over the last, say, 20 years, I like to look at what that Sydney has been doing on an annualised basis of growth. Okay. Actually, sorry, let's go back to 30 years. I think 30 years gives you a bigger picture of what's going on.
Yep.
Sydney's average around 7.5% annually, which is pretty good, and that's why we, average growth rate in Australia, the term they always use is around 6.8 to 7% annually. Mm-hmm. Melbourne's around that 8%, so it has outperformed Sydney from a capital growth. But of course, there's many years where Melbourne did not do anything. There was times in the 70s and the 80s Melbourne wasn't the most expensive city.
Yep.
Same in the 90s. In the 90s, early 90s, where there was a recession in Melbourne. Crazy thing was that Melbourne property prices went back and down 30, 40% during that time, from 89 to 95 roughly.
Cool.
During that time, you had Brisbane, Perth, Hobart on fire. And so it's funny how things happen, because not everything happens when there's recessions in every single state and territory.
Yep.
It happens, all over the place. So I look at annualized growth. You look at Brisbane. Brisbane's average around 5.9% annually. So it's not nowhere near
over the last 30 years.
Over the last 30 years.
Cool.
Okay, it's not really, outperformed the market at all. Mm-hmm. Perth has probably done a lot better than Brisbane, 8.8%. So if you look at Perth has massive upswings, but in the past it has massive downswings.
Cool.
Now, if I had to convince someone to say, "Hi, what do other regional towns have done?" Okay, we can just go start run off. I can start run off some off the top of my head here, but Townsville 6.5%, probably not as good as Melbourne and Sydney. You got Newcastle 8.4%, which is pretty good. Probably it's outperformed Sydney. Big regional town. You got Launceston 8.1%.
Wow.
Geraldton 8.3%. Mount Gambier in South Australia 8.3% over the 30 years, and then Bendigo 8.2%. So you look at that; it's outperformed a lot of the cities
over the last 30 years.
Even Brisbane, it's outperformed Brisbane and parts of Darwin and parts of as well of Perth. So you look at that, and I say, okay, well, you've got Geraldton during the same time when you had Perth do so well, 150%. Geraldton grew up 200%. You had Brisbane 200 and something percent. So there is diversity in these areas, because during those times as well, when there was a property market in Perth went backwards, okay, we didn't see the same aggressive, data go the same way with Geraldton.
Explain that.
Geraldton didn't go into this massive downward trajectory like Perth did.
Gotcha.
It was very diverse.
Gotcha.
Now, population in Geraldton's around 50,000 people. but it's not a mining town. People think it's a mining town, but it's not. It's not just, it's got mining there, of course, but it's got massive other things. It's got, the transportation distribution center. The port's the biggest port up north. A lot of goods and services go there. So logistics is very big. Of course,
So still things driving the economy.
things driving.
And
You've got
that's why it didn't go
educational
through a
sector.
downswing.
You've got the healthcare sector is very
Gotcha.
big there. One of the biggest employments in Geraldton.
So that is more of a diverse / stable economy than, at that particular time than what Perth was, essentially is what you're saying?
Yeah, of course. Because, of course, there was a lot of jobs bringing into the city of Perth as well from these
Gotcha.
big mining corporations. They come into the city working inside the Perth, of course, or they're leaving Perth and flying out also. And then what happens is they leave because of, hey, we got to cut staff. Mining's not doing so well. We got to, reduce our staff here and starts, letting go of people, redundancies, etc. Perth had a massive drop off compared to some of the regional towns. They didn't really face
interesting.
that. There was decreases, of course, but I'm not saying it wasn't as aggressive as Perth during that time.
Cool. Yeah, Bendigo's an interesting one as well. It's performed better than Melbourne over the last 30 years.
Yeah, it has.
That's madness.
Mount Gambier, a place that, once again, it's on the way from Melbourne to Adelaide. It's a small regional town. It's got logging. It's got the healthcare sector. It's big on logging and farming as well, agriculture. That property market is bulletproof, been one of the best property markets in the last 5 years.
Yeah, awesome.
Nearly grown 100% as well. So in the last 5 years.
I don't know if you have this, but again, I'm just trying to think from the viewer. I can't pay my bills with percentages. Now, what do I mean by that? I couldn't give a fuck about Gambier, Townsville. Like the average purchase price is what, 600K now? 650?
Where's this in Mount Gambier?
Townsville. Call it Townsville.
Townsville, yeah.
What, like 650?
Yeah.
Geraldton, 600K, 550, right? Aren't I just like, I don't care if it has 50% growth. If the average purchase price is around that 500, 600K mark, when the average purchase price in Melbourne, let's say, is $1 million, aren't I just much better just being in a Melbourne market and do 10% than a Mount Gambier and say 20%? I don't know if you have this sorted. I remember we've spoken about this a while back. We did a podcast on this. Have you got any details on that?
Yeah, I have. And I've done it on purposely because
beautiful.
I wanted to...
That was not planned, by the way. I genuinely did not know if you did. So
I wanted
good
to
stuff.
share this because people like to put their money in where they know. And, majority of our viewers and listeners are from Melbourne or Sydney.
Mm-hmm.
So I've done a comparison with Sydney and I wanted to pick Townsville. Townsville hasn't... If we look at Townsville, it's done average 6.5% over the last 30 years. Okay, Sydney's done 7.6%, so a lot more aggressive. I've used the same growth rates for this example. So 7.6 for Sydney, 6 point something percent, what was it, 6.5 or said just before? Yeah, 6.5 for Townsville. Townsville at the moment, mean house price is 575.
Yep.
Sydney, it's around the one. Now, wherever you get your data from, it's always going to be different. But I've got off 1.7 mil, okay, for Sydney.
Gotcha. Because
I'm talking inner Sydney. I'm not talking outer ring, so inner ring Sydney. Now,
and obviously there's going to be different factors. So,
of course.
So the nerds out there just going to question the data. There's Bondi and there's this and there's that. Yes, that's going to be different. This is an average, correct? Average on both cities.
Yes.
Cool.
So cash flow for Sydney at 6%, okay, is negative $47,000 a year. Okay?
To hold
the asset, including I've even just put rough utilities in there.
And what's the deposit on there? 20?
20.
Yeah, cool. So 20% deposit on a $1.7 million property, which is $350,000 deposit plus costs.
Yep.
That'll cost you $47,000 a year. Is that correct?
So about 430 deposit.
430 deposit,
Yeah.
including stamps. Yep,
Yeah,
awesome.
yeah.
So 430K. Beautiful.
We go to Townsville.
Yep.
Negative 8,800.
On a 20% deposit.
20% deposit, about 150. Okay.
So a third of the cost.
Over 10 years, 10 years, I've used the growth rate. So I used the Sydney growth rate and the Townsville. You look at Sydney, the property will be worth 3.7 million. Sorry, 3.6 million roughly, just under 3.6. Then you've got, of course, Townsville at 1,085,000. Okay. Over that time, but this is where the numbers say a different thing. Cash flow wise, it's cost you nearly $400,000 to hold that property in Sydney.
Over the 10 years, yep, 47 times.
And I've just left 6% interest rate over 10 years.
Okay.
I haven't factored that it's going to go down or up.
Yep.
Townsville, it's cost you 45 grand.
So a tenth.
Okay. Cash flow in 10 years' time, you're going to have 2,200 positive cash flow in Townsville.
Cool.
You're still going to be negative with the Sydney property, $27,000 a year.
Cool. So still costing you? Yep.
Okay.
That's fine.
Where my debate is like, okay, well, don't put all your eggs in one basket, because regardless of how great that equity is or how much a property has grown, the property is now worth nearly 3.6 mil when you bought for 1.7. You could have done the same thing and bought 3 properties in Townsville at the same time, okay? Use 450 grand of a deposit. So you used about 430 for the Sydney, 450, so a little bit more, an extra $20,000, okay? You're negative $26,000 for the portfolio, but after 10 years, it's $3.2 million of growth of what the property portfolio has grown by. Overall, it's cost you about 135 grand negative a year, negative over the 10 years to hold that portfolio.
As opposed to 400.
But in the 10th year, the portfolio is making around 7 grand positive. Not life-changing, but what happens is during that time, because the properties aren't holding, you're not costing you so much to hold the properties, you're able to get more debt and buy more property.
Cool. Yeah. Okay. Let me just summarize that because I'm following, but I'm the viewer here. So you've gone, I'll just roll off the numbers. 1.7 to 3.6, let's say. Portfolio's cost us 47K. By the end of it, it's $27,000 that it's costing us.
Correct.
That's the Sydney property. Townsville, one property, costs us 8 grand. And by year 10, it's 1.1, $1 million, 1.1.
Yep.
Your argument, and then it's not costing us anything, it's a couple grand positive by the end of the 10 years, which is great. Your argument is if you were to buy 3 assets, you wouldn't buy them all in Townsville. You'd obviously buy them around, but you're just using that as an example. You'd turn the 1.5 mil into how much? How much was it?
You're going to 3.2.
3.2. So 3.2, so which is 500K less than what the other Sydney property would have grown to. However, that property is not costing you anything, and you've also saved 400 grand in negative gearing. Is that correct?
Or yeah, it's cost you 400 grand to hold the Sydney property after 10 years. It's cost you 135 grand to hold the 3 properties in Townsville.
So it's almost the same valuation, just one situation, one scenario is it costs you a whole lot less. You're probably going to open up a lot more borrowing capacity, and you're obviously diversifying your risk over multiple properties than the first.
Yep.
But exact same scenario.
Yep.
That's interesting. Okay. Maybe I might be swung. I mean, my argument to it would be, well, hang on, now I just need to deal with 1 property as opposed to 3 properties. That's a typical argument that someone's going to throw at, and we hear this every single day. Well, that's just too much of a headache. I know what our belief is. It's like,
then don't do it. Don't invest in general if you're worried about headaches.
Well,
it's a business.
Yes, but it's also mitigating the risk. So there's 2 ways to look at buying multiple properties versus buying 1 property. If you buy 1 property, the way I look at it, the way you look at it, is all the risk is on that market. So what happens if you got a property in Sydney, like in the last 3-4 years, the market hasn't done anything. You can't release any equity. Now, the way that we invest, you've got 3 assets, so you've split your risk by 3, 33%, 33%. I look at that and that's mitigated risk. Yes, you're going to have a couple more headaches, maybe tenant here, tenant there, but you're also, the beauty of it is you're going to be able to tap into equity at different times because all the different markets hopefully are in different cycles. So yeah, I don't know. I'm with you. If it's the exact same value, I think that's the big piece here. The exact same equity release.
Because you look at it, the Sydney property, just under 3.6 million. Okay, the value of the property is, but it's cost you 400 grand. So just wipe off 400 grand off that 3.6.
3.2.
3.2. You can, so you look at that, and it's not costing you nowhere near as much. The whole, it's not the grain is not as much as what you think it is. But of course, your cash flow is very reliant. Now, for most people, probably can't even do that situation where they hold a property, as an investment for that long as well, because it can cost them a lot of money.
40 grand a year. Yeah.
So even Melbourne, I've done Melbourne and Bendigo, because Bendigo has the percentage of growth over the last 30 years. I think it's higher or just on par with Melbourne.
And what a beautiful city Bendigo is.
Oh,
we went there
a couple months ago.
What a beautiful city.
And the gold rush, and it's, a lot of money spent over the years, and
Beautiful.
very, very, very diverse as well. Headquarters of the Bendigo Bank. You look at it, $1 million medium house price roughly in Melbourne. Okay. Over 10 years, 2.3 million of value. If you buy just 2 properties in Bendigo, okay, 1.1 million to get into those properties, those 2 properties in Bendigo.
Yep.
The portfolio is worth 2.5 million, so it's actually more. You've gained more growth in Bendigo by buying 2 properties than just buying your 1 in Melbourne. not the stat, the cash, it'll be cash flow positive after 10 years, the portfolio, about $7,500 for those two properties in Bendigo. You're still negative $11,000 a year with the Melbourne property.
Yeah.
So
that is a better argument. I like that. And again, just for the viewers, if you buy certain assets in certain entities and the property's taking care of itself, you also have the ability to open up more borrowing capacity, which is super important. But I like that. Okay.
It's funny. I'm doing a bit of research in a market. There's a market, you got Donnybrook and you've got, Beveridge, these places in Victoria, north of Melbourne. Okay. You could call it metro or regional city in Wallen and those areas there. A lot of it's a new estate. Mm-hmm. And it's funny because I'm looking at migration patterns, internal migration. There's heaps of people migrating there. The new estates, okay? New young families are migrating there. I look at that area there, that's the Mitchell Shire. It's not doing well from an economy perspective. The housing market's doing not bad, not good at all. And it's quite interesting. I look at that, it's a metro town. You could classify it as a metro town. It's just past Craigieburn in Melbourne here. The housing market's not doing well. There's no jobs. Everyone's coming in from there into Melbourne and working. And of course, there's no real growth in that market at all. Okay. Probably market's actually gone backwards in those areas.
Still today?
Still today.
Holy shit.
I look at that and that's risk and that's in a capital city. And a lot of buyers agents are selling these properties out there. These are ones off the plan.
Oh, okay.
In these
areas.
They're flogging a dead horse. Same goes in these parts of Geelong. When I was talking about Armstrong Creek and Dundee and all these other areas there, there's a lot of new estates getting built there and migration patterns, but the economy is not doing really anything. So there's more risk in capital cities. And the reason why I look at that is because you have these big developers developing on the outskirts and people think it's Melbourne, but everyone's coming into Melbourne or other parts across Melbourne or the other greater side of Melbourne and driving hours and hours to get to their location of work. And there's really nothing happening in these towns at all. It's just people living there and leaving to go to work.
Yep.
When you look at regional towns like Albury, look at Albury Wodonga, what a property market. You've got diversity, multiple jobs. I think it's got 9 industries greater than the state average. You've got the ATO headquarters. You've got the distribution centre for, Woolworths. It's everyone lives in Albury and works in Albury. They're not leaving and going to an hour down the road. Same goes with Wagga Wagga. Same goes with Launceston. I can just start
Townsville
Geraldton
as well. Yeah.
So now things have changed. There's a lot of jobs, a lot of opportunity. There's more stability in those markets than parts of Melbourne. Of course, in certain parts of Melbourne, there's some good stability in their fringe locations. But these new estates and these new urban areas, they're very bad areas to invest in. And I say it all the time.
Nothing driving it.
Nothing driving it.
I think it's a really good point because I hear this actually quite a bit of if you spend $500,000, you're just going to get low socio-economical people. You're not going to, it just must be a shit area. It's actually not the case. I think it's very important what you just said right there. Albury, medium house price, 600 now?
600 plus, yeah.
Right? 650 buys you an asset in the region. So when we say regional towns, and I remember when you and I, we went to Newcastle, when we were in Sydney, Newcastle.
Yep.
And we drove through. Remember, I'm like, this isn't a region. This is a city. This is a city. So don't think of regional towns. Think Geelong. That's a perfect example. Think of Bendigo. They are cities. $500,000 gets you an asset in the middle of the city. It's not exactly what you said. It's not a fucking outskirt of Beveridge where you got to buy for, that in a Bendigo might be a $300,000 property, but that's on the outskirts. We wouldn't buy in that area. $500,000, $600,000 gets you an asset in the particular area that you want to be buying. And people, like you just mentioned, like your Aubreys, people are going there. There's ATO headquarters, there's this, there's that. That is a lot more desirable area, a lot more of a desirable property than a fucking Beveridge where it's on the outskirts and people are leaving to go to work, right? So it's just, you've got to go and visit. If you're really scared of regional towns, a few things to remember. One, they're not regional towns. It's not it's not fucking what's the thing called? The Tumblestar? The
hay bales.
Hay bale. It's not that, right? These are cities. They are cities and they are desirable cities. Obviously, if you do your research, there are things driving that particular economy. Now, and the beauty is with $500,000-600,000, you can actually get in the middle of that city. So it's just a different way to look at it as opposed to, I definitely wouldn't be putting my money in a new estate, a new place that's just been built up, even in Townsville or into Albury. I wouldn't be buying in an outer fringe suburb where people are not there's no desire to live there. So I think it's a good point.
So, yeah, I think regional versus capital, there's pros and cons with regardless of where it is. I think there's opportunity, and you look at it as a stock market. Back to the start of this, look at it as a stock market. Invest in areas that are going to do well. Don't worry about what it is. Invest on numbers, invest on the economy, invest on what's happening there, and buy that property. I hate hearing all these big, buyers agents flogging saying, no, it's capital city, blue chip, blue chip, blue chip. They don't even know what blue chip is. It's like you not everyone can go into blue chip. Not everyone can afford to hold a $1.5 million house that is going to cost them $40,000 a year, regardless of how much growth it is. Not everyone can do that.
Yep.
And the cost of living is more expensive. Property is getting out of, it's getting out of reach for some people. This is the way in investing in the new age, I believe.
I like it.
And I like it. I think, yes, more properties, more headaches, but there is less risk. Less risk, more return, less cash flow restraint on yourself. And of course, you do this over 30 years and you invest every single day or every single time you can invest, you'll be surprised of how many properties you can build by doing this.
Yeah. Yeah.
A Townsville can get to $1 million medium house price.
It will.
It will.
Definitely.
In Albury, there's houses at $1 million plus, and it'll keep going.
Of course.
And it'll keep going in Bendigo, keep going in Geraldton, it'll keep going in Townsville, everywhere. So I think people look at it and go, the medium house price can't get to that. What do you mean? If you go back 10 to 15 years ago, in these areas you could buy a house for $200,000. Now these prices are worth $650,000, $700,000.
Yeah.
So it's like it will get there in the next 10, 20, 30 years. It'll be over $1 million in these big regional towns. And Melbourne and Sydney, guess what? It's going to be even more expensive.
Of course. Yeah, and it's all going to follow the trend. I think the big piece, because I'm just thinking about it, playing devil's advocate, because I want to be only in capitals. The example that you used of Sydney versus Townsville that you used, if I can diversify my risk and not have all of my assets in one asset, the Sydney asset, and I can buy 3 assets with that same 450, let's say, but it gets me to the exact same value, less headaches, because financially, year by year, it's costing me a quarter, or it's costing me a lot less than what the $47,000 in Sydney is. I get the exact same valuation at the end of it, so same equity position. But most importantly, I've diversified my risk. That, for me, that makes sense. That's why I'm like, yep, cool. I'm open to now regional investment. I'm open to cheaper assets. As long as the risk is not there in the growth. And I think you also illustrated that. 30 years, buy property in Bendigo, we'll just use Bendigo, has got better growth than what Brisbane has had. That's telling. Yeah. I look at that and go, okay, cool. You've got some flavour here.
I love when people knock a regional town that we're investing in. Mm-hmm. Today we're trying to convince them, but if they're too hard-headed, we just say, okay.
Yeah, not for us. Yeah, not for us.
I want people to listen to this because it's important. What did Brisbane do from 2012 to 2018? What did it do?
Jack shit.
Jack shit. It actually went backwards in value in some areas, 5 to 10%. Done nothing. No one wanted to invest in Brisbane. No one. Now everyone's like, I want to invest in Brisbane. I want to invest in Perth. You didn't even know what it was doing back then, and you're knocking a regional town. You've got no clue what's going on. Look at the data. And I get angry because it's like, stop thinking that capital cities are the be-all, end-all. It's not. It's absolutely not.
You could say the same, but you can, again, say the same. If you bought a property in Melbourne in 2019 to today, you're absolutely crushed. 20%, 30%, if that, in some places, sometimes backwards.
Yeah, some places have done from 2019. You kind of bought at the top of the market.
That's right.
And then, of course, you had COVID, and then it's gone back below COVID prices.
Yep.
So you've kind of lost. But there's some areas, of course, have kind of held their value.
Yep.
But you've lost. So you could have done something where 2019, I bought in Brisbane, my property's grown 150%.
Yeah.
I paid $300,000 for a house in Brisbane. It's worth $750. And
I bought in 2021 for 412. It's worth 900. So there you go.
There you go. Yep. So you just look at it, and it's like, there's so many opportunities out there.
Cool. I like it. You've convinced me purely off the factual information. The factual information being if I buy 3 assets over to 1, they'll be worth the same value if you buy correctly. And that's we're talking about Sydney, median house price 1.7. But I think most importantly, the 2 big factors that I'm like, yeah, value's cool, is the diversified risk. I think that's super important. I think that's more important than anything else that you've really said. And then obviously the fact that I get to still go out for avocado on toast because I'm cash flow perspective. It's not killing me to hold 1 asset or 3 assets, right? Good good episode. This will be used. This will be sent to a lot of our clients, I think, that are thinking about different areas and should I go capital, should I go regional? I like it. Treat it like a stock market. Beautiful.
Exactly.
Thank you so much. I'll see you in the next episode.
You're welcome.